Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business developments, their context, their relevance and policy impact. I'm Govindraj, Ethiraj. Oil prices have been falling steadily in recent months, hitting 13-year lows below $30 a barrel. Now, falling oil prices are usually welcome, but not this time, with low oil prices triggering fears of a recession. This has in turn affected stock markets around the world, and one reason why Indian markets are now at a 20-month low. Now, back in India, the government has kept back most of the benefits of the fall in prices, not passing them on to consumers like you and me. Now, the larger question is, what do falling oil prices mean for India's economy, which is fighting to grow? Are low oil prices a boon or a bane? And what should be the response economically and politically? To understand this better, I'm joined by Saugata Bhattacharya, Chief Economist at Axis Bank, and Hitesh Jain, Commodity Analyst at IIFL. Thank you both for joining us. Saugata, let me begin with you. Walk us through what's happening in the oil market, so to speak. While it continues to fall, everyone's trying hard to either stop it where it is or try and sort of reap some benefits. Who's benefiting and who's not?
Who's benefiting? With oil, remember, I think what's happened, the change in narrative, when oil started coming down from $115 a barrel down to about 65, our sense is that that was probably more of a supply component than a demand one. The slide from there on, from 65 down to the $25, $30 levels, that was predominantly more a demand-led fall than a supply, although there's a supply component there as well.
So people are consuming less oil around the world.
Or fears that people would consume less oil. Right. Of course, there's the fear of Iran oil adding to the glut in this period of
and China, I'm assuming, is playing an important
role. Coming in from China, because China is a large consumer, large importer of oil.
Right.
So I think that's what changed the narrative. The initial fall was more or less, even for emerging markets as a whole, was considered to be a welcome development. Of course, there were some emerging markets, Brazil, Russia, which were large exporters of energy, that got impacted. But countries like India, Philippines and other oil importing countries, they actually stood to benefit. The problem started with the next round of the fall, because that's when capital markets, as you pointed out, equity markets, other currency markets, etc., those began to get affected, and the story, the narrative of emerging market fragility started from there on, because that was led by China. And that's where all the capital flights, the capital outflows, the falls in depreciation of currency, that's when it started. So I think, as you mentioned, I think there is a certain level at which the benefits, which we are still reaping, major macroeconomic fundamental improvement and space for the government, fiscal deficit, current account deficit, that's when it started getting reversed with the outflow of foreign portfolio investments from the country.
Right. So let's get a more oil view here, Hitesh. So what's your sense? I mean, so one is that it's been falling now because there is fear of demand contracting and the demand in particular parts of the world, and that has in turn implications because if China is the key consumer. But what is the outlook to you?
See, I project it that way. See, oversupplied conditions also always the rhetoric the markets were dwelling on. Oversupply is not a new number, because if you look at demand supply numbers on the oil global balance sheet, if you look at 2012, 13, 14, on the average, oil markets were always oversupplied by 1.5, 1.2 million barrel per day. If you look at this year and the last year numbers from January till November, if you look at Bloomberg numbers, the oil markets are oversupplied by 2.2 million barrel per day. But I think rather than oversupply, it was the laissez-faire policy of OPEC which basically took a toll on the energy markets, and it is quite unprecedented to an extent where you see falling oil prices and players like Saudi Arabia are actually initiating no kind of policy price stabilization measures, and prices are falling. So such kind
and
of
Saudi Arabia continues to pump out oil.
If you broadly actually classify factors which were actually led to just not fall in oil but major commodities, was I would name them as, first, beginning with these loose monetary policy. Second is the transition in Chinese economy, where you are seeing a shift from fixed asset spending to so-called boost in household spending. And third is basically the lag in the recalibration of supply and demand equilibrium in most commodities, in copper, oil, and all. Beginning with first, there's a beautiful saying written by one of the French playwright, where it says that people often die of their remedy rather than illness. Because if you understand, post 2008 subprime crisis, the financial crisis in the US, most of the central bank resorted to loose monetary policy or so-called quantitative easing in order to basically stimulate growth. And what was the outcome actually? We had an antithesis to the actual theoretical, because generally low interest rates should lead to high growth, high inflation. But what we had on hand was high debt, low growth and deflation. In fact, most advanced economies on the verge of deflation.
So you're saying the same thing has happened to oil?
Yes, obviously. So people rely. And
so what can turn?
then see, generally oil is all apart from demand, supply side impetus has to be there. You need some kind of price stability, because demand side impetus will take longer time to, and things can get worse before they get better, because the overall economic landscape still looks fragile unless and until you don't see OPEC intervening or bringing some kind of cut. Why they are not doing, it defies economics. Either it is geopolitics or it's economics, because on the pretext of competing with the US shale producers, or competing with Iran or with ISIs, I don't know.
So you're saying it's not rational, but it's happening nevertheless, and it's not good. That's your conclusion. Okay, so how do we as a country benefit from this, and what should we be doing, Saugata?
Benefits. Current account deficit come down from 5%.
But we are not passing this on to consumers. I mean, that's part is very
clear. That's part of the story. The first is to get the macroeconomics in order, and after that you begin to look at the micro components, whether it's consumption, whether it's using the lower commodity prices into lower input costs for producing economies. But the first thing is you need to get your macro fundamentals in order, and that's happened. Current account from 5% down to 1%, fiscal deficit down from 6% down to 4%, 3.9%. This has given the government the government space to do a whole lot many more things, which would have been inconceivable in FY13.
Okay,
so that's the first. News. That's the good news. I'm actually very glad that the government is not passing on the full extent of the fall in commodity prices. Remember, first, I mean, the fall in oil prices has been neutralized to a fairly significant extent by the drop in the rupee. Because although the dollar price of oil has come down, the rupee price is not, because of the fall in the currency.
The rupee continues to depreciate.
That's right, it continues to depreciate. On top of that, the government imposing excise. I'm actually very, very concerned seeing the way that imports and domestic consumption of petrol, diesel, many other petro products has increased. I do not think this is a good sign, because I mean, this we expose ourselves to the vulnerability of a shock as and when oil prices begin to increase. I think the government has done a good thing. What I do not like in this excise, I think we should have used the excise part, the excise increases, and put that, ring fence that into a separate fund like the road cess fund from petrol and diesel, and use that to develop urban infrastructure transport. I think using these funds, the excise, ring fenced into an urban transportation mass transit system kind of infrastructure development would have been more useful, rather than using this for a broader consolidation.
And it can still be done, perhaps. Okay. What's your outlook, Hitesh, for oil in the next 3 to 6 months, and what effect could that have on other markets, including stock markets and the general economy?
What I feel that we're going to just bump along the bottom, maybe $25-30 per barrel for the next 5 to 6 months, and whatever meaningful recovery would see in the second half. And I said somewhere sanity will prevail, and large producers will act. Although we are not seeing any moderation in non-OPEC output as well, Russia is still producing because of the fall in the ruble. They've actually they're having the higher cash realization, because when oil was trading at $100 per barrel, the Russian ruble was trading at about 30.
So what's the impact of all this, Hitesh? So oil means companies that produce oil are affected, countries that produce oil are affected.
Reducing. So I think overall it would be a drag on the overall economic growth prospects, especially commodity exporting countries, where they see a stress on their current account balance, their growth, the GDP growth numbers. So see, as you go by the IMF numbers or the economic agency bodies, I think this year is still going to remain a very dull year, and you will not see any impetus of actually seeing a kind of recovery in the growth prospect. So I think this year has to be dull. But as a commodity price forecast are concerned, unless and until you don't see supply side response happening from the supplier side, I don't see a rosy picture.
Right. So what's your sense on the economy, first, I mean, global, and to the extent that we are linked to this because of this, right? So low oil prices can also act as I mean, it's a negative also for a lot of people, and therefore can slow things down. It can make life difficult.
It has. I mean, as we have seen, I mean, the first major concern that we have had, other than exports, slowing exports, is the prospect of capital volatility, capital outflows. To a very large extent, our funding plans, so to say, domestic funding plans, relied a lot on foreign capital flows, foreign capital pools, of which portfolio investments were a significant part. We have had to significantly downgrade prospects of a portfolio, large portfolio investments coming in, both into our equity markets and so on. So that automatically reduces the scope of funding. So that's one. Exports are a very major component, because as a result of oil, commodity prices.
And this has happened in the past as well. I mean, portfolio flows tend to come down when oil prices come down.
Well, I mean, the last time we had seen this was in 2008, following the global financial crisis. So that was the time then because of not just commodities and oil, because of other financial conditions, there was a massive outflow and risk protection, risk mitigation, flight to safe havens and things.
So big concern is that.
But remember that the major difference between that was a very sharp spike, sharp downturn and a sharp climb back up. This time that's not going to happen. This time it's going to be a sustained low levels, a much more like a J curve rather than that steep V curve that we had seen the last time around.
Okay, so let's sum up very quickly. So what's your sense? I mean, if you were to look at the next 3 to 6 months, you're of course saying that your forecast is that prices are likely to remain suppressed unless there is supply side action, which is some countries should raise prices or OPEC should raise prices. Apart from that, what are you looking at?
We see the jury is still out. How about China's transition is going to take place? It's going to be hard landing, soft landing.
So George Soros says it's going to be a hard landing.
So nobody knows. So from literally 8 to 9% of GDP growth, we have come down to 6.8. I don't know, we go to 6.5, 6.4. So if that happens, that is going to have its own repercussions or ramifications in the overall global economic landscape. So things are not clear, and I think there are still no signs of optimism as far as if you look at the broader global trajectory is concerned. There could be India benefiting from all this, but then see, I again reiterate that there's nothing called decoupling theory.
Okay, got it. Last word, Saugata, the outlook and way forward.
Well, I mean, it's up to us I mean, our fundamentals are very sound. I think a little bit of a push to reforms, to getting some initiatives going, getting some capex going. The bankruptcy code, if and when the GST comes in, I think India is positioned. It will be our game to lose if we don't do this.
Right. Okay. That's a good note to end on. Thank you so much for joining me. We need to take a break here, but coming up on the other side, we look at the impact of China on the global markets, including India. Stay with us. Hello and welcome back to Policy Watch. China has just said that its economy grew 6.9% in 2015. Now, this is the lowest number in 25 years. The numbers were not a surprise in themselves, but added to the long list of bad news emanating from that country, which at peak has consumed almost half the world's cement, coal, iron ore and steel. Now, China's troubles have triggered nervousness and panic across world markets as it moves from being an export-led economy to one based on domestic consumption. Now, the transition is not without its pain, affecting stock markets and currency markets world over. India's own markets have now tumbled to a 20-month low, also driven by sliding crude oil prices. Now, the question for India is, first, what is going on in China? To what extent can that turmoil affect us further? And is it China alone that is the source of these concerns? And finally, can India isolate its economy and markets from further volatility? To discuss that, I am joined by DK Joshi, Chief Economist at CRISIL, and Debopam Chaudhari, Chief Economist at Zyfin. Gentlemen, thank you both for joining me. Mr. Joshi, let me begin with you. Walk us through what China means to us today, where we are as an economy and our relative stage in growth.
Well, I think China is world's second largest economy, so any trouble in China is going to spill over to other parts of the world, and we are also not disconnected from that. I think that's pretty obvious from the two incidents, one that took place in 2015, when middle of 2015, when China was devaluing its currency, and now again, I think in the beginning of 2016, I think when China again became an exporter of risk and volatility to the rest of the world, and I think India was was also impacted by that. Now, what China is trying to do is, first, as you rightly mentioned, I think it is trying to move its economy away from investment-led growth to consumption-led growth. I think while that is happening, we are also seeing another trend that it is moving away from industry towards services, which means it is becoming less resource intensive, and that's spilling over to the rest of the world as lower commodity prices and also contributing to lower crude prices. I think the second thing that China is trying to do is it is trying to liberalize its economy, particularly the exchange rate regime. I think China was introduced into the SDR basket. I think now there's a conflict there. While I think China is trying to open up its currency markets, but it also has a habit of intervening or controlling the economy. So I think this conflict becomes inherent when becomes more visible when China tries to intervene in its forex markets. It tries to stabilize its stock markets. I think the way it is doing it is creating a lot of nervousness among foreign investors. I think it is leaving them confused. So I think the Chinese authorities need to communicate their steps much better, and think so that markets are not taken by surprise. Now, as far as India is concerned, I think we've seen that the Chinese turmoil spill over to our currency markets. It roils the capital flows in the region. So India also gets hit by that. I think in addition to that, I think the Chinese slowdown is not, as you rightly said, is not something completely unexpected. The growth was expected to slow down, and actually China seems to be following a L-shaped path. I mean, where the growth has fallen from the double digits to around 6.5% to 7%, and I think now the authorities are trying to maintain it at that level. I think as long as they succeed in doing that, I think the turmoil for the rest of the world will be under control. But if China slips much faster than that, I think then that has bearing on rest of the world and also on India. Now, India, I think as far as the trade relations with China are concerned, they are lopsided. I think we import a lot from them, but export a few items to them. Our export items are very elastic, I would say, because the China's demand for resources has slowed down, so our exports.
How are we bearing the effect of this transmission? Is it that China affects the world economy and the world economy is affecting our markets, or is it China's problems are affecting us directly? What is the weightage that you would accord to each of these situations?
Well, I think we are getting hit both ways. I mean, it is China has a supply chain. I think when China's exports slow down, the rest of the countries associated with China slow down. When their growth slow down, then our exports to those economies slow down. So that is one relationship which is indirect. The direct relationship is via our exports directly with China. So that's where I wanted to point out that what is happening is that our imports from China are not slowing down, but our exports to China have slowed down dramatically. So that is bloating the trade deficit. So I think while the developments in China are softening commodity prices, crude prices, which is good news for us. It is hitting us from the export side, which is not so good news for us.
Okay, so let's pick up on one or two things. So Debopam, let me ask you a question based on a statement that Governor Raghuram Rajan made in Davos. He said that China is not falling off a cliff. So essentially what he's saying is, hold on, don't worry, everything including the currency fluctuation that we're seeing is under control.
Absolutely right. So on a lighter side, right now I'm having green tea, and that is a Chinese concept. So that's the impact of China on our day-to-day lives. So yes, when Raghuram Rajan says that Chinese economy is not on the brink of a crash or anything, that's absolutely correct. There are some inherent problems, like the demand may be slowing, the inflation may be a little uncomfortably low, and the debt pile up is a little higher than is expected than that was expected by Z. However, these can be solved by maybe a loose monetary policy, which can have an impact on the currency, weakening the currency further. But then again, please remember, China has a huge stockpile of foreign exchange with them. They have like $3 trillion of exchange foreign currency just lying with them. So weakening currency should not be an immediate problem for China. So I totally subscribe to what Dr. Rajan said in Davos, that Chinese economy is well protected.
Right. Yes, and yet the markets are reacting violently. Our own markets are sliding, and there's of course the oil and currency factor to worry about. So why is it that then there's so much worry if all of this was in some ways predictable?
See, the jitters that we saw in the markets, in currency markets as well as equity markets over the past since the beginning of January. In fact, the global markets fell 7%, which is the largest decline since 1970. But according to me, this is more political than economic. The crash or the jitters that we see is more of a sign that investors are now not very confident of the Chinese government, Mr. Xi and his team, that they have that amount of control left which they used to enjoy. We all know the Chinese government was a supreme power, and they could even control markets, not just the economy. Somewhere that confidence is going down, and Mr. Z needs to address that, as DK was also suggesting. And the only way to do it is reforms, because if they don't carry out reforms now, then what will happen is they will again go back to unsustainable stimulus, which will force the economy back into a recessionary kind of an environment.
Right. Okay. So, DK, what is the lesson here for India? Lesson is, let's say, one part of it. The other is trying to understand to what extent are we insulated, and if not, in the next few months, and what do we need to do to better protect ourselves?
Well, I think we have done enough to better protect ourselves in some sense, because our macros have improved. The growth, the inflation, the current account deficit, they are all in the I would say in a pretty attractive zone compared to what they were 2 to 3 years back, and also compared to our peers. So we are okay that way. I think forex reserves, you can pile pile up more, but I don't, I mean, in case there is a turmoil, I think they don't help too much. I mean, even China has blown up its reserves by something like a little over $500 billion last year. I mean, and the total, they run a surplus of current account surplus of around 500 billion. So they have intervened in the market to the tune of $1 trillion. I mean, so all I'm saying is that we have measures in place which make us less vulnerable, but they don't insulate us. I think the only way to ensure that we don't slip too much is to carry out the reforms which keep the investor confidence going. And I think once the dust settles, I think the investors will have a differentiated view on the markets, and I think India would look attractive, particularly if I think it moves along on the reform front. I think some of the steps government announced last year, like Indradhanush program or let's say Uday program for the power sector, I think all those have to see light of the day in 2016. I think if that starts happening, I think then I would say that we have a good pull factor to attract capital, and I think we have less vulnerability because our macros are good. I think you need to keep consolidating on that front.
You're saying, therefore, that in some ways I'm seeing interesting parallel. So you're saying that China should continue reforms and so should India, Debopam. So therefore, both need to continue reforms so both can protect themselves and we can protect ourselves from the rest of the world and China for that matter.
See, protecting ourselves from the rest of the world may not be a valid statement given this globalized context. So you have
what I mean is the volatility. I mean, you know, the way the markets are crashing, the way investors are pulling out money. That's what I mean. Yeah.
So you have to improve the perception of the Indian economy as a whole, the control the government has on the various economic levers, to gain the confidence of international investors, international players who are interested in India. So once that confidence is instilled, once our ratings improve, even if our economy is not showing very good, great statistically growth numbers, if that perception improves, definitely investments in the country will improve, and gradually we will.
Right. So focus on the perception as we're trying to do in Davos right now.
Sentiment management.
Sentiment management. Okay. Last word, DK. What should be the way forward? I mean, this is really from an India point of view now.
Well, I think 2016 is a very critical year because I think it's very critical year from 2 points of view. One, I think whatever government has announced in 2015, they should really push it hard. Whatever non-legislative reforms, I would call them. I mentioned few of them. And I think second thing is I think they should really try to get consensus on GST and the bankruptcy code bill. I think if you do that, I think that's good enough, I would say.
Debopam?
What India should
do? What are the 1 or 2 things that are on top of your
just quickly
bucket list?
Give you one good thing that is happening in China, and people are not very vociferously talking about it. If you look at the amount of shopping Chinese companies have done, both government companies and private companies, in the last 1 year, they have spent 61 billion in acquiring various companies in the Western world, in the developed world. So that is a very clear indicator that the Chinese entrepreneur world or the Chinese corporate sector has very strong forecasts for the domestic economy, and they are building on their the manpower, the talent, the technology which they lack by acquiring these companies. So 61 billion is a huge number.
Right. So you're saying they're building their core strengths, and that is something that's going to help them out.
They are confident about their economy.
Right. Yes. Okay. So that's a good note to end on. India needs to do better. India needs to bring back its reform, which of course it is doing quite actively. That's all we have time for, unfortunately. We've run out of time on Policy Watch. We'll be back next week, same time. Thanks for watching.